Hello everyone out there, this is Alexander F. Ornilleri from Kellybon Crypto. And I guess what's on my mind right now is the 4-year Bitcoin cycle broken? Various crypto experts and influencers have been asking the same question.
If Bitcoin bounces back from here and breaks higher this month, it means one thing and one thing only. The 4-year cycle is dead.
For the 4-year cycle crew, we're about at the end. This is about the top. If you're not in that crew, this is the beginning.
Is the 4-year cycle broken? What are your thoughts on all?
The demand for exposure to Bitcoin is really at an all-time high. And so with the demand for Bitcoin outpacing supply, I think the cycle is broken.
The 4-year cycle, in my opinion, is definitely over. And it's definitely over because the credit-driven fiat cycle is over.
We are getting into the bull territory of this 4-year cycle. The reason that many in crypto have always pointed to for this 4-year cycle that I have not fully bought into is the halving, because it turns out that the Bitcoin halvens its supply about every 4 years. Maybe the 4-year cycle is not caused by the Bitcoin halving. Maybe it's something else.
The 4-year crypto cycle comes from Bitcoin's halving schedule. Every 4 years, the block reward paid to miners is cut in half. This reduces the new BTC supply entering the market. Historically, it has triggered a supply shock, followed by a bull market of 12 to 18 months later, then a crash, and then a bear market that lasts until the next halving.
Bitcoin's heartbeat is the halving, a hard-coded supply cut that fires once every 210,000 blocks. The 4 events so far in 2012, 16, 20, and 2024 have each sliced BTC issuance by half and, in doing so, throttled the steady stream of coins coming to the open market. Supply shrinks overnight while demand gradually rises in tandem. As many analysts and investors believe, the imbalance is the spark that ignites the major leg up in the typical cycle, and the sky is the limit. The theory states that as the market realizes a new scarcity regime is in force, a reflexive reaction occurs. A rising chart pulls in headlines, headlines pull in fresh capital, and the circular feedback loop sends prices upwards at an increasing rate. Historical performance underscores the potency. From halving to cycle peak following each of the first 3 halvings, Bitcoin rallied roughly 95 times, 30 times, and 8 times respectively, an eye-watering average that cements the number go up legend. And typically, momentum outruns fundamentals, ushering in the short, spectacular climax of a blow-off top. Miner profitability spikes, long-term holders transfer billions in dormant coins to exchanges, and leverage ratios reach cartoonish levels just before liquidity evaporates.
But now, according to Coin Bureau, it all looks discombobulated. The 4-year cycle normally goes something like this.
Most people are still trying to fit into the old 4-year pattern, and we hear it all over crypto Twitter timeline and other YouTubers. It's the halving, then it's the rally, then it's a crash, then it's a recovery, rinse, wash, repeat. But this time, that script no longer explains what's happening. The data tells a new story. We're in a phase shaped by global liquidity, debt, and politics. Forces powerful enough to stretch every rhythm the market used to follow.
Kyle Chaser there. What everyone is saying that this cycle feels very different, very weird, and Coin Bureau explains it better in this clip.
This bull run feels a little weird.
Weird. It is weird.
Crypto is supposed to waltz to a neat 4-year rhythm. Halving, hype, blow-off, blues. Instead, we have spot ETFs and corporate entities vacuuming up supply ahead of retail investors, meme coins mooning before blue chips, and the world's largest economy forming a strategic Bitcoin reserve. And this all makes it more difficult to figure out where exactly we are in this market cycle.
Let's watch this clip while Jesse Eckel goes into more detail.
The Bitcoin halving drives the 4-year cycle is the single biggest myth in all of crypto. And if you're still using that myth as your map for this market, you're about to walk off a cliff. The truth is, it was never the halving that drove the 4-year cycle, but a liquidity echo from the 2008 financial crisis that was completely shattered after COVID policy response. And the wide-held belief behind why this pattern exists is that it's driven by the Bitcoin halving. And this is something that I also used to believe. And instead, these 4-year bull runs were driven by huge bursts every 4 years in year-over-year liquidity.
Jesse Eccles goes on to add that China entered the money printing business and allowed its citizens to now trade in Bitcoin, and that Mt. Gox allowed peer-to-peer trading cross-border. This added to the liquidity flow. This being the nascent development of Bitcoin meant the cycle was still being determined. First, in 2012, the halving year, the bull market peaked in 2013. Bitcoin was approximately $1,100. Percentage gain from the halving was 10,000% in 18 months. We're never going to see that again. The last halving we had was in spring 2024, so it's expected to peak in late 2025. Each time BTC halved, it rallied for 18 months, and then it topped and crashed to 70 to 80%, with altcoins crashing to 90%, consolidating until the next halving. The question is that still valid in 2025? What we've come to realize is the halving coincides with the business cycle, which up till now has been 4 years, which coincides with the M2 money supply. Now, people like Savvy Finance and Raoul Pal are now arguing that the business cycle is expanding into 5 years. So obviously, if the Bitcoin cycle was following the business cycle, the M2 money supply, it follows that it's probably now going to follow it in extent to 5 years. Is this a valid argument? Well, Raoul Pal thinks so.
Global macro investor Raoul Pal explains why the 4-year cycle is now the 5-year cycle, and Bitcoin should now peak in 2026.
Why is Bitcoin not wildly off to the races yet? This is a detrended Bitcoin, and it's basically the ISM, which is the business cycle. Why do we have an elongated business cycle that looks like virtually no other real other time? It's because in 2021-22, they actually extended the maturity of the debt from 4 years to 5 years. So that extension of the maturity of debt has pushed out the business cycle a year. The 4-year cycle this time around is a 5-year cycle. We don't know what the next one will be until we see where they all end up getting refinanced. But this one is a 5-year cycle, and it tells us the ISM should peak by 2026, probably Q2.
Let's check out Tom Lee elucidating about the ISM, how the ISM and liquidity is the fundamental of this bull run that we're sort of running out of very fast.
A lot of folks are kind of questioning if we're in a 4-year cycle. The most correlated factor to Bitcoin prices when you see a Bitcoin at a peak actually is the ISM. So I think we're still in a correction phase of crypto. Crypto suffered from that liquidation event on October 10th, but because the fundamental story is intact and we crypto discounts the future, that's why it's volatile, but it still looks pretty attractive here.
Tom Lee there, taken from Ivan on Tech. Number 4 argument would be liquidity cycle. The concept of global liquidity is basically this: expansion, peak, contraction, then recovery. Now, the big 3 drivers for liquidity are the Fed balance sheet, which is quantitative easing and quantitative tightening. Number 2, global credit growth. That's the bank's willingness to lend liquidity far larger than central banks. Number 3, cross-border capital flows. Here's a clip of the godfather of liquidity, Michael Howe, explaining this concept.
Liquidity coming into the US markets really courtesy of the debt ceiling over the last 6 months. I know there are a lot of fears over the next 6 months about whether that money is going to be taken out again. I'm not so sure it will be. So I think liquidity in the US still looks pretty good. What we know is that of all the central banks we monitor, and we monitor close to 100, about 80% now are actually in easing mode. So that's a high number for sure. So China in the last 6 months has added, something like 10 trillion yuan, which is close to $1.5 trillion. They've probably got to do the same again, but this is a great start.
And Michael, just how closely do you connect that easing in global liquidity conditions to the very easy financial conditions across the world?
They're connected 100%. There's no question about that. This cycle is getting old. It's 34, 35 months old. I think that's a few months away yet. I think we're not talking about 2025. We're talking about 2026 for an ending.
In China, through the PBOC, they've been providing lots of liquidity in the Chinese market, but it's still not enough to offset USDC tightening. The BOJ in Japan is gradually retreating from the kind of ultra easing policy. As for emerging markets, there's some tightening due to USD pressure. So what we're seeing here, that macro liquidity is everything. Nothing else matters. We could be looking at a 5-year cycle. This is rammed home continuously by Raoul Pal in this clip.
Okay, are we anywhere near the cycle top? I know people frown, oh my God, Bitcoin's at all-time high. Surely I'm going to be buying the top. Surely Raoul's shilling things at the top and he's trying to find exit liquidity and all the nonsense that people talk about online. Basically, a liquidity indicator is nowhere near where it's going to go. Also, look at the acceleration that happens before it peaks out. We haven't done anything yet. This has been super mild, so expect the acceleration ahead. We've still got the exciting part where prices go vertical lying ahead. It's the light blue line here that's a little bit hidden, but really what we're doing is we're more closely following, let's say, the 2015-18 cycle, which I think is how it plays out this time, as opposed to the stunted cycle of 2020.
That clip there taken from Kyle Chaser as well. So arguments about it changing could be the market is now matured. We now have institutions, derivatives, which makes Bitcoin less dependent on the retail hype cycle. There's less volatility in this market. Number two, BTC is now a $1 trillion asset, so it's not going to show explosive boom bust like in the early years. Number three, there's continuous liquidity flow from the ETFs and more constant capital flow and outflows. So the price action is going to become smoother. So it's just going to be another asset that rich people invest in. And retail looks like they're out of the market, except for you and I. We're like super retail, I guess.
Where primarily before this, it was like millennials and like the poorer generations that were bidding up the price of Bitcoin. But finally, these boomers were like convinced it's time to jump in because Larry Fink and everyone on CNBC is telling them, hey, this is the future, tokenization. You should put, X amount of your portfolio into Bitcoin. Their financial advisor that they're sitting down with is saying, hey, you want to allocate some into this Bitcoin ETF? And so they're taking a portion of their portfolio and they're allocating it into Bitcoin, which is where you're seeing these flow-based bid into crypto, which is a lot different structure and type of flow than a retail-induced mania that comes from this huge bursts in year-over-year liquidity. And in fact, the institutional bid of crypto, this says institutional structured bid, but that's not quite the case. I'm talking like the institutions that have trillions and trillions to invest into crypto. That hasn't really even started yet. You're going to see that ramp up starting in 2026 into 2027, 2028. Like that just gets bigger year over year over year. But obviously what most people are just seeing is Bitcoin's at all-time highs. It kind of feels similar, market's now crashing at the end of 2025 and they're like, oh my gosh, this is the 4-year cycle, it's over. But that couldn't be further from the truth. Yes, we are at all-time highs, but it's not been driven by financial easing. It's been driven by structured flows.
There's now a correlation with market trends. Bitcoin now moves more like a risk asset. There's less volatility. There's also the fact that gold has been on a tear this year, going over 4,000. And everyone in crypto is hoping Bitcoin will play catch up in the next few months. We're also expecting 50% basis cuts from Jerome Powell, the Fed, in December. Could this be something that will spike Bitcoin up? The US government also ended the shutdown after 43 days.
We're going to turn now to the end of the government shutdown. Rachel, you've been following this since the beginning. Federal workers going without paychecks, millions not getting their benefits. What happens now?
For the past 43 days, Democrats in Congress shut down the government of the United States in an attempt to extort American taxpayers for hundreds of billions of dollars for illegal aliens and from gangs, from prisons, from mental institutions. They wanted to pay them $1.5 trillion.
The Trump administration has started handing out $10,000 bonuses to TSA workers who they say went above and beyond during this shutdown. It's unclear just how many workers are going to receive that $10,000 bonus. The president also making a similar promise for air traffic controllers too, but it's unclear where that money is going to come from.
All positive things for liquidity to rise up. Ivan on Tech is expecting a short bear market after early 2026.
Like I agree that printer is gonna come, macro is gonna be fantastic. But the thing is, it's gonna be a bit later. Like it takes time for all of this to unfold. The interest rate cut that we've been discussing for a long time, it takes so long to happen. And so Bitcoin will have time to have a few quarters of bear. If the 4-year cycle turns out to be correct, we will have a few quarters of bear easily within the time frame before the big printer turns on for real, before Powell is replaced from the Fed like we've been discussing. That's going to happen in May. Powell will be removed in May. So as you can see, there's a lot of time until the actual liquidity will hit the market.
Ivan on Tech. Donald Trump is saying he's going to remove Jerome Powell and already earmarked member of his cabal, Stephen Mirren, to be the next chairman of the Fed. And just before the new chairman of Fed comes in, we then expect heavy liquidity in the market. So the current outlook is we're 18 months post April 2024 halving. right in the historical bull phase window. The other things you notice is that Bitcoin's been bouncing around the 50-day moving average. And even though OGs from like 5 to 10 years ago have been selling billions of Bitcoin, it's still not going tanking straight down, and it's getting swallowed up by the new investors who have billions and are hovering up the selling pressure. That's one change in the market structure that this time is definitely different.
So why is it that with everything going on, this asset just cannot go up? Well, the answer is pretty simple, and it's evident with the on-chain data. The reason is because these whales are selling their coins. The people who were the true believers in Bitcoin. The on-chain data shows that cohorts that bought Bitcoin 3 to 5 years ago and have been holding Bitcoin since 2020, they're now the biggest sellers of Bitcoin. So why are they selling? And why are they selling now? Well, the answer is pretty obvious. It's pretty simple. And the answer is because every investment, no matter how big your conviction, eventually reaches an exit scenario. What's the point of investing in something if you're not going to realize the returns?
Altcoins like Sui, Solana, Pulse are hemorrhaging right now because there are just far too many altcoins, and you have to kind of pick the right one, like Zcash, Dash, Aero, Asta, BNB. They're the only ones who really are going up. That's the difference from former bull runs where you could just throw cash at anything. It would have gone up 10x. But with all the crashing that we've been having in the last 4 days and Bitcoin going 85, can we really afford to discount the 4-year cycle? Or are you still going with this new 5-year cycle? Last bull run, every influencer banged on about the new super cycle.
Last cycle, many people fell for super cycle, man. So this, I mean, unbelievable. But this time, people also fell for the super cycle because when we started to discuss the Bitcoin returns from last halving and just comparing the cycles, I swear people said 4-year cycle is dead. I mean, it's exactly what they said last cycle. How can it be like that? It's exact. It's not even a bit different. It's actually exact. It's exact. It's to the freaking day. Like, it's exact. How?
Ivan on Tech. The same supercycle idea has been derailed by the old traditional Bitcoin 4-year cycle. So what are the key takeaways? The mechanical halving rhythm still shapes the broad crypto sentiment, but the amplitude of boom and bust is probably likely to go away, and smart investors are going to use the cycle as a macro framework. They're not going to use it as a trading calendar. A great proponent of the extended cycle is Raoul Pal. He expects this to go longer than the 4-year cycle, and then we get the banana zone. I certainly hope so. So until next time, this is Alexander F. Onileri looking at the end of the 4-year cycle. Let me know below if you'll say yay or nay, hello, the 5-year cycle.